Two professionals sit down and look at the exact same financial report for a company. One takes a look at the price, stamps the file rejected, and walks away. The other checks the same numbers and aggressively hits buy. How can they both look at identical data and reach completely opposite conclusions? Because they are playing two entirely different games. It's the oldest friendly argument in investing: value versus growth. If you look closely at the mutual fund industry, you'll see it physically divides itself along this line. Whole portfolios are built strictly for the value camp or the growth camp, pulling completely different stocks from the exact same market. This split is intentional. It's a choice between two opposing philosophies on how to survive a market where the future is entirely unpredictable. Every investor shares one common problem: we don't have a crystal ball. Predictions fail, markets turn, and people are frequently wrong about where a business is heading. In 1949, an investor named Benjamin Graham proposed a defense against this human error. He wasn't interested in building better prediction models. He wanted a way to invest that would survive even if his math was slightly off. Graham's answer was to build a mathematical shield into every single purchase. He called it the margin of safety. This chart shows how that shield actually works. We have a taller bar representing a company's calculated intrinsic value, what the business is genuinely worth, sitting next to a much shorter bar representing its current market price. The empty space right between them is the strict definition of the margin of safety. Imagine checking the books of a steady, profitable chai stall. You calculate the business is worth exactly 1.4 lakh rupees, but the owner is tired and wants to sell it to you today for 1 lakh. That leaves a 40,000 rupee gap. If your initial calculation was a bit too optimistic, that gap acts as a literal shock absorber to protect your money. This physical gap is exactly what value investors hunt for. They look for unglamorous signs of a bargain: a low price-to-earnings ratio, a low price-to-book ratio, or a chunky dividend. They are betting that the broader crowd is temporarily too gloomy, and that eventually the current low asking price will snap upward to match the reality of the business. Now walk down the street to Chai Stall B. It just opened near a metro station. It barely makes any profit yet, but the owner is asking a steep 3 lakh rupees. A growth investor will look at this chart, showing a tiny current earnings dot sitting below a massive 3 lakh asking price, and they will gladly pay it. They abandon the margin of safety completely to secure tomorrow's scale, but the risk is steep. You're paying for a future that has to actually show up. If the metro traffic fizzles out, growth flatlines, and that premium vanishes, you just severely overpaid. That is the core divide. Value investing is securing a tangible discount today. Growth investing is paying a premium for a theoretical tomorrow. Most real-world portfolios don't live at the absolute extremes. Take Peter Lynch, who ran Fidelity's Magellan Fund in the 1980s. He blended the two approaches into a strategy called Growth at a Reasonable Price, or GARP. His main tool was a mathematical bridge called the PEG ratio. You calculate it by dividing a stock's price-to-earnings ratio by its actual earnings growth rate. A PE of 20 might sound expensive on paper, but if you check the math and find those profits are expanding by exactly 20, strategies like GARP attempt to find safety right in the middle, relying on verifiable momentum instead of chasing extreme discounts. Even if you've never actively chosen a side, you are already participating in this dynamic. Every single equity fund inherently leans toward one end of that dial. You can see exactly how this plays out by looking at the broader market's current mood, like the Nifty 50 in July 2026. This dashboard displays exact metrics for the index. We see a PE of 20.9, price to book near 3.1, and a 1.2% dividend yield. This tells a clear story. Indian large caps aren't dirt cheap value plays. The market prices in a growth premium for expected expansion. Take a moment to pull up the mutual funds you own right now. Compare their PE and PB ratios against that nifty baseline. If they are higher, you're tilting growth. If they are lower, you're leaning value. Neither approach is inherently wrong. They simply take turns winning. But willingly paying a premium without knowing which game you are actually playing is a quick way to lose your money.